In today's video, I want to take you back to the year 2000, March 10th, 2000 to be exact. Because on that single day, the NASDAQ Composite hit 5,048 points, the single highest point it had ever reached in its history. And then the very next trading day, the whole thing started to fall apart. And I want to show you this because the reason I am bringing you this video today is not just a history lesson. It is a warning. Because right now in 2026, I am watching the same psychology, the same behavior, and the same dangerous pattern of ignoring fundamentals that I saw in 2000. And if you understand what survived the dot-com bubble and what turned to absolute dust, you are going to have a massive advantage over every other investor out there who is living in ignorance, living in bliss. So let me set the stage here with the data, because the numbers from that crash are genuinely shocking, even by today's standards. Between 1995 and March of 2000, investments in the NASDAQ rose by 600%. 600%. People were becoming millionaires on paper in a matter of months. In fact, someone who had invested $100,000 in the NASDAQ in 1992 would have had $850,000 by early 2000. People thought the laws of economics had been rewritten. They thought the old rules no longer applied. And listen, that right there is always the most dangerous sentence in the history of finance. The old rules no longer apply. They always apply. They always apply. And then the collapse came. By October of 2002, the NASDAQ had fallen 78% from its peak. 78%. Not from some fringe index. The primary stock market index for technology in the United States. And in total, by the end of the downturn in 2002, stocks had lost $5 trillion in market capitalization. $5 trillion gone. And over 52% of dot-com companies did not make it past 2004. 4 out of 5 dot-com companies in Silicon Valley alone shut down in 2000-2001. It's as simple as that. This was not a market correction. This was a financial extinction event for a generation of overvalued, profitless companies. Now I want to show you some of the names that turned to absolute dust because this is where it gets really unsettling. Pets.com. You remember the sock puppet mascot, the cute commercials, the Super Bowl ads. The company had the backing of Amazon.com. It went public, and exactly 9 months later, it was gone. Zero. Done. Webvan, the grocery delivery company, raised over $800 million from investors, burned through all of it, and went bankrupt. Boo.com, the online fashion retailer, burned through $180 million in just 6 months and collapsed. Priceline, one of the biggest names of the era, fell 97% from its peak. Its stock went from nearly $1,000 per share all the way down to $6.60. Nortel Networks crashed 95% and eventually filed for bankruptcy in 2009. And here's one that I think is the most instructive of all. Cisco. Not some fly-by-night startup. Cisco was the most valuable company in the world at the peak of the bubble in 2000, with a market cap exceeding $500 billion. Its stock fell 88%. And here's the part that nobody wants to tell you. Cisco stock did not fully recover to its March 2000 levels even 24 years later. Take a look at this. At the peak, the price-to-earnings ratio on the NASDAQ Composite had surpassed 90. 90. To give you context, a normal, healthy price-to-earnings ratio for a broad index is somewhere around 15 to 20. The valuations were so disconnected from reality that in October of 1999, Morgan Stanley tracked 199 internet stocks with a combined market cap of $450 billion. And their total annual sales? $21 billion. Their combined profits? There were none. Their combined losses were $6.2 billion a year. And people were still buying. And Wall Street analysts were still upgrading these stocks. That is not investing. That is gambling dressed up in a suit. But you might say, Brian, what are you talking about? Everybody lost money in the dot-com crash. That is not true. That is the mainstream story. And that is the story that the financial media wants you to believe, because it lets the banks and the fund managers off the hook for loading up retail investors with garbage. The truth is that several specific categories of investments not only survived the dot-com crash, they actually went up while the NASDAQ was in free fall. And those 3 investments are the subject of this video. Let me show you. Investment number 1, real estate investment trusts, REITs. Now I want you to look at this data because it is remarkable. While the NASDAQ fell 78% between 2000 and 2002, REITs delivered a return of 26.35% in the year 2000. Not negative. Positive 26% while the entire technology sector was getting wiped out. And then in 2001, REITs returned positive 12.35%. And in 2002, they returned positive 3.75%. 3 consecutive years of positive returns in the middle of one of the worst stock market crashes in American history. Now, why did this happen? Because real estate operates on entirely different fundamentals than internet stocks. People still needed to live somewhere. Commercial tenants still needed offices. Warehouses still needed to be leased. REITs collect real rent from real tenants and pay out real dividends to investors. That is a real business model. The dot-com companies were burning cash with no path to profitability. A REIT is the exact opposite of that. It is the antidote to speculation. Listen, I am not here to tell you that real estate is a magic bullet in every environment, but the lesson of 2000 is extremely clear. When speculative bubbles pop, real assets win. Tangible income-producing assets win. And the investors who understood this in 2000 while everyone else was chasing Pets.com and Webvan were the ones who did not have to rebuild from zero. Investment number 2, consumer staples. And I want to show you this because the numbers here are almost unbelievable. During the dot-com bust, from 2000 to 2002, the S&P 500 fell 22.3% on an annualized basis. But the consumer staples sector of the stock market returned positive 11.2% annualized during that same period. Think about what that means. While the technology sector was down anywhere from 70 to 95%, companies that made food, household products, and beverages were returning double-digit positive gains. We are talking about companies that sell things like soap and cereal and toothpaste. Products that people buy whether the stock market is up or down, whether they just made a fortune or just lost everything. Procter & Gamble, Johnson & Johnson, Coca-Cola, these companies have something that Pets.com never had. They have earnings, they have free cash flow, they have pricing power, and they have customers who are not going to stop buying their products just because the NASDAQ is crashing. And this is the core lesson of consumer staples. In a bubble, boring wins. In a crash, boring wins even harder. The companies that were the least exciting, the ones that nobody was writing breathless articles about in 1999, those were the companies that actually protected wealth when everything fell apart. And to be specific, Southern Company, a utility company, actually gained 132% during the 2000 to 2002 bear market when the broader index was down nearly 50%. 132% positive return. It's a no-brainer when you think about it. People do not stop using electricity. They do not stop buying toothpaste. But they absolutely do stop logging on to an unprofitable internet pet food delivery service. Investment number 3, gold and precious metals. And this one is the most important one for what is happening right now in 2026. Gold entered the 2000 crash era undervalued and unloved. It had been beaten down throughout most of the 1990s as the stock market boom made every other asset class look unattractive. But when the dot-com bubble burst, gold started a multi-year run that most people who are glued to NASDAQ stocks completely missed. From 2001 to 2003, Newmont Gold Corp, one of the largest gold mining companies in the world, returned positive 185%. Freeport-McMoRan, the copper mining giant, returned positive 397% during that same period. And this was not just about individual stocks. The entire thesis of gold as a store of value in times of financial chaos was confirmed in a very dramatic way. And here's what I want you to think about right now. In 2026, we have an unemployment rate ticking upward. We have oil prices above $90 a barrel. We have consumer credit card debt at a record high of $1.28 trillion. We have a Federal Reserve that is being pressured to cut interest rates even though core PCE inflation is still running at 3.1%. And we have a stock market that in certain pockets is showing the same kind of valuation excess that we saw in 2000. The writing is on the wall. Now, I want to contrast this with the mainstream narrative because this is where I have a real problem with what you are being told right now. The politicians and the financial media want you to believe that everything is fine, that the economy is strong, that we are, and I quote the narrative here, in a golden age, but the data does not support that at all. A record 6% of Americans enrolled in 401k plans made hardship withdrawals last year. Consumer delinquency rates have doubled from 4% to 8% since 2022. Over 42 million Americans are in student loan debt, and approximately 25% of them are now delinquent. And wages are not keeping up with the real cost of living. They are living in ignorance, living in bliss. And the government is printing propaganda, not economic analysis. The dot-com crash tells us that when the market finally forces a price discovery event, and it always does, the assets that are grounded in real cash flows, real income, And real physical value are the ones that survive. The ones built on hype, narrative, and the idea that this time is different, those are the ones that turn to dust. And it does not matter if those companies have the most exciting technology or the biggest Super Bowl advertising campaigns. Pets.com had a Super Bowl ad. It was bankrupt 9 months later. But you might say, Brian, are you saying another crash is coming? Listen, I am not here to give you financial advice. I am here to show you the data the same way I always do. And the data says that asset bubbles built on speculation and disconnected from earnings fundamentals do not survive when interest rates rise and liquidity dries up. That pattern has repeated itself over and over again across history. The dot-com crash, the housing crash of 2008, the crypto collapse of 2022, the pattern is the same every single time. And every single time, the people who are diversified into real assets, into income-producing investments grounded in fundamentals, come out the other side in a far better position than those who went all in on the next big thing. If this trend continues, and I am telling you right now, with a weakening labor market, rising oil prices, elevated inflation, and unsustainable levels of consumer debt, I am getting concerned about the overall economic picture in a serious way. The dot-com crash wiped out $5 trillion in wealth in 2.5 years. That is not ancient history. That is a blueprint. And the question you need to be asking yourself right now is not which technology is going to change the world. The question is, which of my investments will still be standing if the world changes a lot faster than the market is currently pricing in? That is what the survivors of the dot-com crash teach us. Real estate with real income, consumer staples with real earnings, and gold with real store of value. Those are not the most exciting investments in the world, but they are the ones that did not turn to dust. Subscribe to the channel for daily updates. Thank you so much. Have a very nice day. Take care.